So, hello friends, let's talk about SAPM as our exam scheme. Exam scheme is announced, so we need to be very fast to complete all these topics. So, see, this is chapter number 3 actually. This is approaches to investment analysis. I think I taught it in YouTube earlier as well, but no problem. I will start from this chapter only. Okay. So let's start with the chapter that is approaches to investment analysis. See, here there are several approaches actually. There is Dow theory, and this is very important that I have marked even random walk theory, trend analysis, and modern portfolio theory. These are really important. Actually, these also is important that is capital asset pricing theory, but it you must have studied in your financial management part as well or in inform first year if you have studied like many even didn't study because they had a kind of intuition that exams will not be held, so it is up to you. So this is what these few theories we need to remember. This trend walk theory, trend analysis, this all we will study in our upcoming chapter, that is technical analysis chapter. Fund flow theory, what you need to remember, that is fund flow theory, you need to remember it is basically meaning it basically means that here we are simply trying to find out the changes in working capital, right? Fund flow, it means by this only. There are two levels which it works upon, that is macro level and micro level, right? How it works for the macro level, like it talks about the economic growth of the country. It says that how there is like how the production of goods and services is happening and what is the level of investment at that point of time, especially funds, like because fund flow, that funds will be coming if investments are there, whether that is of FDI or in form of local investment, whatever may be. So domestic investment, foreign investment, whatever may be in any form, that is what it talks about, that how those investments are leading to economic growth, that GDP is how is it increasing, it is talking about that only. तो ये सिर्फ जीडीपी की बात करता है, सिर्फ तो नहीं कहेंगे क्योंकि ये एक बहुत ही बड़ा we could say that a huge scenario is found out in this part. Now micro level we see that simply that how market is operating and how what are the forces behind it. Fundamental analysis, which is industry, company, and market analysis. These three involved. Economy, sorry, not economy, like in other form you could say industry, company, and economy analysis. Now economic, industry, company, forces, it is already there. As I told you, fundamental analysis includes all this. Now fundamental and physical performance analysis, this is also there. Now I will be very quick to teach you all this so that it I am able to cover it all better way. Okay, so this is what you need to remember, four things, but this thing, if you remember, if you don't know, don't remember, no matter, it does not matter a lot actually, because fundamental analysis itself includes industry, economy, and company analysis, and these are few forces which help the flow of fund or restrict it. Okay, you need to remember the both parts. Now, next is that the fund flow statement presents what it presents. We know it, right? A statement of changes in working capital, fund flow statement, and of course adjusted profit and loss. You see that all, and how these are applied, and how the sources of fund. This all we know very well. You could know one name, you could remember one name, that is Beerman. And how do we bear our fund in that way, that it is a statement which highlights the underlying financial moments. Okay, so this is highlighting the underlying financial moment and explains the changes of working capital from one point to another point. Simple, very easy. So that is simply like it is highlighting underlying financial movement. If it is does, it does not mean that you need to just quote the same word by word. You need to know the concept. Simple, that it is highlighting the financial movement simply, and that in working capital, like how from one point of time it is changing in another point of time. Simple. Dow theory is really important, that I have already written, that is in the technical analysis. Page number 142 we could jump just now, but I would say that let's see that later. Okay, we will see this Dow theory said that at that point of time, like like absorption, like market absorption related, actually this is not absorption, I think it is observation, that how are you observing the market, how highs are high than earlier high, how lows are low than earlier low. So that is, see, let's take an example for a for an instance. Suppose you are just analyzing the market, right? And this is how it is going. Okay, so this is there are three ways, that up uptrend, downtrend, and sideways. There are three things which come here in this sorry, Dow theory, and these three things you need to remember in this one. Okay, so what does it say, like how, what Dow says about uptrend, when it says that there is a uptrend in the market, when he says that there is a downtrend in the market. So it is all that we will study in that chapter. Now, when the market absorption and information flows are not forced and complete, and the market prices will move around the intrinsic worth of the securities. So if, see, very simple part, that if we do not even know about the information that how that particular share is going to perform, of course that intrinsic part will play a huge role, as Bill Gates analyzes like everything, and thereafter he invests. So they, okay, Mr. Bill Gates, I should be respecting him. Okay, no problem. We are already respecting. So the intrinsic pricing of shares is to be evaluated in terms of its earning potential, like EPS, distribution or amount of dividend, PE ratio, and financial ratio. So these are few points which we need to remember. Okay, intrinsic pricing of the shares is to be evaluated in terms of what? EPS, PE ratio, financial ratio, all these. Now then comes the forecast of the prices is to be made to assess whether the share is overpriced or underpriced. Okay, okay, so overpriced and underpriced, we will be comparing it with the others so that we can get the real thing. Okay, the investor can adopt the principle of buying underpriced shares and selling overpriced. See, why is it important? I must tell you, because Dow theory is one which is used a lot, in especially by those experts which you see that copy their part and then trade in the market, share market. That is what we need to remember. Okay, next. So then efficient market theory. See, Dow theory, they have not, I'm telling you that these are just few features. Complete theory we will study in technical analysis chapter. Let's move fast. Now, efficient market theory. Efficient market theory works under the condition of ideal setup. Okay, because we are just high, this is the just kind of hypothesis that we are taking, and not in the real world, right? It is just a hypothesis. Now this theory clarifies that market can adjust the new information generated from economy, company, and industry as well, and this can be done quickly and efficiently. It just thinks, it just information, like it just like a kind of clarifies that how these particular information of economy, company, and industry be used to make a market very quick and efficient. Okay, now under the efficient market theory, what happens, that prices are determined by market forces. So market forces are determining price, so that you need to remember first, because it is efficient market theory. Okay, market forces are influenced by perfect and free flow of unbiased, accurate, and costless information. Okay, so it should be, there has to be three particular criteria. Okay, so what will happen, I'm telling you, unbiased. It should, data has to be unbiased, accurate, and costless information. Do you really think that it happens in the market? Of course not. So that is why this theory does not exist in the real world. It is just a utopia of the share market. Okay. So in the efficient market theory, market efficiency are two types, like operational efficiency and informational efficiency. Let's just mark it, that is operational efficiency and informational efficiency. Operational efficiency will be measured by factors like time taken. Let's take some other ink. Oh, yes, let's take this one. Okay, so operation efficiency measured by factor like example time taken in the execution of order, etc. etc. And operational efficiency is measure of the swiftness and the market selection. So operational efficiency, informational efficiency means how the information can easily be applied and directly be applied into some particular operation. So informational efficiency is what we say, like just not operations but also the administration. There are three particular main parts. Okay, so what are the parts? That is operation, administration, and execution. Okay, so administration, that making the policies, and execution, that implementing the policy, and operation, that is after the how these at the time of the execution, that how these are operationalized and functionality, how the specificities are reached up to certain level. So that is what you must know. Okay, so I hope I am clear with it. Now next comes, that is random walk theory. Okay, random walk theory. Just someone said, I don't remember the name, but he said that market can it's unpredictable. Okay, so if market is unpredictable, so how will you gonna be predicting it, right? So that is he said, and this is a random walk theory. Simple. Assume that prices of share cannot be predicted on the basis of historical or past trend. Following are the main assumption. Like no one can predict the prices. Market is efficient. All information is quickly absorbed in the prices. The prices move in random manner. So this point you could relate with the efficiency, like efficient market theory. Okay, so this is a theory which just we have studied, and it is not complete. I'm again telling you. So this is what we have to complete it in this way. So the price is going up and down equally due to an average investor cannot earn more than the average profit. Average investor cannot earn more than the average profit. So be a kind of like a efficient investor, not just an efficient expert investor. The expert investor is one who is a kind of who can just not access particular information, but also use that at certain time in efficient manner. Now comes the capital asset pricing theory. Capital asset pricing theory in a CAPT, like that is the return is same on various portfolio, which is really important. Return are same on various portfolio. Okay, understood? So this is very important. You need to remember this. In the capital asset pricing theory, market risk remains. This theory abolishes the company risk. So this is capital asset pricing theory. It abolishes the risk. This you need to remember. So market should be free market. Market should be large number of players. Players should influence the demand of supply. So how will it happen? Let's take an example. Like suppose if everyone is playing their part and there is no no one is receiving any other one, not blocking the path. So of course everyone use its full capacity, and that full capacity when is used, then the level playing field will be created automatically. This is actually the hypothesis which is made by this capital asset pricing model, pricing theory. And here the market price should be free market. There should be large number of players, and the players should influence the demand and supply forces, and the resultant price should be fair and competitive prices. So the following, so this is what a like following equation is there. Actually this following equation we have already gone through. So this is what, like what is this actually, this I will tell you. Beta is what? Beta is that kind of risk. Okay, which will be taken. So that is return in the market, return in free market, return also, that is RI stand for the rate of price appreciation on script. Okay, then RF, like it is risk free return. It is risk free return. RM means stand for market risk, and beta is constant. Beta stands for the constant which relates to premium of the market rate, that is risk free rate. So this is, oh sorry, it was not the risk one, that is beta, that is premium. So that is stands for the constant which relates to the premium of the market rate over the risk free rate. Okay, again I will just repeat it for you. That is nothing but, that is first RI means it is rate of price appreciation on script. Risk free return, that is market risk. RM means market risk, and BI, that is constant, that is what which relates to the premium of the market. Okay, so hope you have understood well. I've used all my capacity. I'm using that too even now. So trend walk theory is some very simple. Okay, it says that investors follow the past trend and buy those which other are also buying. So this is the kind of influential theory, that how people are influenced by the others. So the trend is set by the trend setter, and investor who follow the trend is known as trend walker. Okay, so who follows the trend is called trend walker, and this trend is set up by the majority. Trend is set by the majority. The market is determined by the past trend, and the trend walkers are average investor. Actually, there is one more assumption behind it, and not just as assumption, but actually it happens actually that there are some suppose this is happening. Okay, so at this point of time where the returns are very low, at that point of time this promoter invests because they know that it has potential to grow. So when they invest huge amount, so just all of the sudden it jumps on. Then when it jumps, then it keeps on little bit increasing and growing. So when it is growing, then people see that okay, this is growing, let's invest in it. So they keep on investing, keep on then there is a saturation point which when it arrives, so promoter just takes back their money. Then this when it was going like this, and when in this promoter takes their money back, then it goes just like this. So this happens in the market. That is trend walk theory. Then here these particular loops are called trend. So that means here they are setting trend here, and then with this trend the people are buying more and more, and thereafter they just take back their investment. So this happens. Trend walk theory of course is really important, and it actually happens, and people lose their money many times, especially the average buyers. Now, modern portfolio theory, that is closely related to CAP, capital asset pricing. According to modern portfolio theory, what happens that different types of risk cannot be eliminated completely in any investment. Okay, I'm see why I am telling you all this. Let me show you one thing. See, what do you understand by fund flow theory? Explain the feature of Dow theory. Okay, this came. Any other theory may be asked, if not in chapter, at least in the other chapter. Okay, so that is why I'm telling you each theory, and later upon I will leave you on you as well. So be participative while studying. Now, next comes that is method of trend. Okay, this is done right. That is eliminated. We cannot eliminate. Of course, investor would like to choose least risky with high return portfolio. So least risky with high return. So that is a risk return trade off. He will try to just manage anyway. And the investor should classify the companies into those with complementary competitiveness. So that is complementary and competitive. There has to be some those companies where which are all complementary as well and competitive as well. Okay, so that has to happen. If it does not happen, anyone is missing, so it will be difficult for the investor to continue for the long term because of course some risk is there. Okay, complementary and competitive. So understood. Now next is what method of trend analysis. What will be the method? See, it is very important. This trend analysis is very important actually. In the interpretation of financial statement, trend is general tendency. Trend analysis is very actually it is really very helpful in forecasting, and trend can be made in the any of the following forms, like it trend ratios. To trend ratios this can be done, and but it has given just one, right? Okay, let's see what is this. It is saying that, see, trend analysis is very important because along with fundamental analysis, if you see that suppose companies there, okay, it's economy, it's the industry, and the company itself is going well. But suppose all of the sudden you get to know that that a kind of virus corona is coming, right? So that if COVID-19 is coming, or just you don't know about COVID-19, but you might be having some knowledge that at this particular point of time the disease outbreak is possible, right? So no matter how strong the company is with this fundamental analysis, you have to substantiate, like it cannot be eliminated, but like supplementary material has to be available. If it is not available, then of course it will create some kind of confusion, and of course risk will be created for sure. Okay. Hmm. So what is that trend ratio? Like for calculation of trend ratio, what do we do? That information, like calculation of trend ratio information and data available in financial statement. Okay, why is it not working? No problem. Okay. Okay, okay. Sorry for the interruption. There is some problem. No issue. I will try using this one. Okay, thank God it has started working. No problem. Let's move further. What is happening? Don't know. Okay, no problem. What will I do? I will just tell you the thing, and you have to substantiate with it, like with this. Okay, so trend ratios, like for calculation of trend ratio, information and data available in financial statement of several years are tabulated. An item out of item of many years is taken as the base year of the ratio for the amount of the same time is treated as trend ratio. And trend analysis is a statistical technique which is used in the beginning. It is used in a portfolio analysis to know to analysis to and know to the index of prices. Okay, by the way, this is not working. Let's see. Okay, well then remember that we have studied Dow theory, we have studied random walk theory, and we have studied like what did we complete, that is very simple, that is random walk theory, right? And these few things like how trend analysis is important, how calculated pricing method is important, why is it important. So this all we have seen, right? No, no. Modern portfolio theory, I told you it is just like the APM, right? What else is there? Like risk is reduced in this because portfolio means diversification. If you are creating a portfolio, then of course you must be having different company security, different industry security. So that is what we could say, that reducing risk, and companies it chooses and so should classify the company, those companies competitive, complementary and competitive. These two points to remember will be enough for you to complete the topic. I mean, complete the answer. Now, for the purpose of trend analysis, trend of the different items of the different period is calculated, where various variations are measured through it. For it, increase or decrease the item. Its interpretation is difficult because rate of each increase or decrease for other year is found out on the basis of base year. Okay, so that means each increase or decrease is found out on the basis of base year, and trend analysis provides information regarding the rate of increase or the decrease. It provides knowledge actually whether the increase or decrease in the favor or adverse. Okay, so that is what it tells you. Now, what has to be the precaution in trend analysis? That is, first thing, that trend ratio of the single item is useless. That means trend analysis has to be every with it has to be compared. Analysis should compare with trend ratio of other concern. And if any decision is taken on the basis of trend analysis, ratio or percentage not based on primary data can be irrelevant and misguiding. So that means primary data has to be used at the time of the comparison between the two particular data. And if similar principle and policies are not adopted, trend analysis would be irrelevant. Of course, similar policies have to be adopted, right? Now, trend analysis, we have seen what is trend analysis. We know this. It is an important tool of analyzing and forecasting the financial statement. It is interpreting the financial statement over a period of time. It is a tendency of the general term that trend analysis discloses changes in the financial and operative data of the financial statement between specific period that we have already talked about, right? It just gives you that how the that particular changes occurred, if whether those were favorable or unfavorable. It is talking about the tendency how the accounting data is showing the financial provision position of the company, and it is actually the immensely helpful tool which is substantiated with the fundamental analysis to make it complete and relevant for a particular time. Now, difference between modern and traditional portfolio analysis. So let's see that. Very simple. You must be knowing and you must know about the meaning. What is meaning? So, meaning is that is modern portfolio analysis. That is Harry Markovich is regarded as the father of modern portfolio theory. According to him, investors are mainly concerned with two properties of an asset. Okay, that is two properties of an asset and risk and return, but by diversification of portfolio, it is possible to trade off between them. Of course, because diversification of portfolio, if done, then of course it can be done. Traditional portfolio analysis refers to the selection of securities and with continuous shifting in the portfolio for optimizing the return and maximizing the wealth. So that means here it was not talking about risk return trade off, which might have been at that point of time when it was used be really dangerous at some points, right? At some time. What is a study? Investors study include an insight into his return on investment probability and distribution rate of the return, expected return, and variance of return. So various returns they take, like they take insight into. Now, investors study include an insight into his age, health, responsibility, other assets. So this is some traditional like portfolio needs, need of income, capital maintenance, liquidity, attitude towards risk and taxation status. So these like practical things of the particular investment was not at all judged at that point of time when this was used. Selection, how will it be selected? So in this approach, the final step is asset allocation process, that is to choose the portfolio that meets the requirement of the investors who are willing to accept a higher probability of risk for getting the expected return would choose high risk portfolio. Okay, if you want to get higher return, so you will choose high risk portfolio, and investor with lower tolerance for the risk would choose low risk, of course, portfolio. Then comes the traditional one. That is traditional one, the method of selecting sound investment by calculating the true or intrinsic value. So here comes the part of the fundamental analysis. Understood? So fundamental analysis is of course crucial, but it has to be substantiated with trend analysis, which is a kind of modern technique. I told you even earlier as well. Now the comparing that value with the current market value. Okay, you will compare that particular scenario of economy, industry, and company, and intrinsic value. After that, you will compare for now like how market prices are there, market value it will be